Would you like to sell more life insurance? In today's episode, we are featuring Mueller and David McKnight, and they're going to be sharing life insurance tips that are going to have your customers begging to buy life insurance from you. With that being said, let's start the show. A question that we had from our audience was, okay, we understand cash value life insurance is important. As an insurance professional, I want to be having these conversations, but should I be recommending index universal life? Should I be recommending VUL? Should I be recommending whole life? Like, there's so many permanent options out there. What should I be doing to help someone with their life insurance retirement plan?
Yeah, if you're utilizing it in the volatility buffer / volatility shield type context that we just discussed, VUL is not going to work, because in order to be a volatility shield, you can't experience volatility in the shield itself. The volatility shield itself can't experience volatility, and the VUL by definition experiences volatility. So what does that leave you with? It leaves you with whole life, and it leaves you with IUL. And so the question becomes, which of those two is likely to fulfill the role of the volatility buffer or volatility shield in the most efficient way? And the thing that you have to remember is that you have to save at least 3 years worth of living expenses. And that's not your living expenses today. It's your living expenses in retirement. And that could be 30 years from now. How much money you're going to need 30 years from now to be able to pay for 1 year of living expenses? It's going to be substantially more if you figure inflation in. So you really need to have a vehicle that's going to grow safely but productively. Okay, so for example, if you have a financial tool that's only growing at 3%, what's the likelihood that, notwithstanding your best efforts, you're going to be able to save at least 3 years worth of living expenses by the time, adjusted for inflation, by the time you retire in 20 to 30 years? 3% is not going to hack it. So you need something that's productive. I'm talking growing between, and remember, there's a relationship between risk and reward. So you can't get a guarantee against zero loss in the market and still get 15%. There's a relationship there. So if you're going to get zero, what financial tool can grow your money productively such that you will have enough money for this cash value life insurance to operate in the way it's intended? And that's as a volatility shield. And the thing about IUL, and IUL is my preferred choice, is it's historically giving you 5 to 7% net of fees over time. You see some people talk about more, but I'm conservative. I'm saying, look, it's going to give you 5 to 7% net of fees over time. And that, when you look at all the numbers, that is going to give you a reasonable rate of return. It's a productive rate of return. You're not going to have to sell your farm to be able to put money into this thing to be able to have the sufficient amount by the time you retire. So the point is, the more productive your volatility shield account, the less you have to invest along the way to be able to have accumulated the 3 years worth of living expenses by the time you retire. And so the other thing that I like about IUL is, through certain companies, it has guaranteed 0% loans. So what does that mean? That means not only is your money growing tax-free, it's growing cost-free. So when you take the money out, you do so by way of a loan. They use your cash value to collateralize that loan. So you're actually getting a loan from the insurance company, not from your policy. They're just using your cash value as a way to collateralize that loan. So what these companies will do is they'll say, we'll loan you money using your cash values as collateral, and we're going to charge you a real rate of interest. Let's call it 3%. Through certain IUL companies, they will say, okay, let's take an equal amount of money out of your growth account and put it into what I call a loan collateral account. And they will then credit you an amount of interest in that loan collateral account. And if it's a good company, they will credit you exactly what they charge you for the loan itself. So if they're charging you 3% and they're crediting you 3% and they guarantee both in the contract, then when you take that money out, it's going to be guaranteed 0% wash loan. That's what we call it. And no matter what the company does, because it's guaranteed in the contract, they can never charge you a net rate of interest for that loan. And so we need a policy to be safe and productive, and we need to be able to take the money out tax-free and cost-free. And the IUL is the only financial tool that enables you to do both of those things at the same time. When you look at, for example, the Ernst & Young study, where they talk about using this volatility buffer, volatility shield concept, they actually use whole life. And when you look at the fine print, you look at the footnotes, they say that they actually paid back the loans from the whole life policy after the market recovered. So in other words, they took the money out and then they paid it back. With the IUL, you could take the money out and not have to pay it back. Okay. So how did they pay the loan back? They paid the loan back out of their stock market portfolio once it recovered. If you use an IUL and you don't have any financial motivation to pay it back because they're not charging you interest, that means you're going to have more money in your stock market portfolio that you can utilize to pay for discretionary expenses down the road. So, so that's, I think, just a good example of why I think the IUL accomplishes everything that we need to accomplish in the best way.
The institutions and the places that we depend on have become very chaotic, very non-transparent, very not understandable. Government. Do all of us really understand how government works anymore? Stop and think about this. We haven't had a budget in the United States since the year 2003. It's like 100 and some continuing resolutions. How do you build a successful financial future without a budget? And so our government does that. And now we're seeing a very divided country. Give you an example. When we do talks around the country, we say to everybody, Tom Hagner, one of the greats of our industry, he has a famous saying this is scientifically, mathematically, and economically correct. And I give that talk, and all of a sudden the heavens open up and God comes down, actually stands right next to me. And he says, what Van is sharing with you is actually scientifically, mathematically, and economically correct. Want to hear something amazing? In our country right now, this is very sad, 50% of America would still not believe us. So how, under that kind of chaos, can we really believe that government has our back? Are they not trying to figure it out for themselves? And then Wall Street. Wall Street's a mess. You remember during 2007 and 8, we had at that time about $600 trillion in derivatives. We're somewhere between 800 trillion and a quadrillion. Think about that, a 1 with 15 zeros after it, of derivatives currently. And the banks, every bank in America is essentially insolvent because they can do stuff with money that insurance companies are not allowed to do. It's called fractionalized investing. They can get $1 million and then they can loan out somewhere between $10 and $20 million to people using that $1 million as collateral. So if 5 to 10% of those loans go bad, and gosh, do you think that could happen right now? If any of those go bad, those banks are insolvent, then we're going to have to bail them out. And I'm not telling you to scare you. What I'm telling you is we'll bail them out. But here's my question. Where will we get the money? And isn't it true that we'll have to raise taxes and, we'll have to apply the stealth tax called inflation? Aren't we going to print money like it's going out of style? Oh my goodness. And doesn't that make it a spectacular time if you really understand how cash value life insurance works? Isn't that pennies that buy dollars and $1 that can literally do the work of many dollars? And then finally, the last institution, Wall Street and the banks. So you have government, Wall Street, the banks, all probably going to fail us and let us down. And you know what's so neat about being an insurance and financial professional? You can go to every single one of your customers and say, I have a surprise for you. In spite of everything they do that's bad, what if you could develop a strategy that not only could they not hurt you, but every time they make a blunder for the rest of your life, you'd be in a perfect position to take advantage of whatever thing they made a blunder on for the rest of your life. And then I have a bigger surprise for you. You guys ready? What if you could do all of that with reduced or even total elimination of your income tax liability? If you knew you could do that right now, when would you want to get started? And so you know what the problem is that we think it's about products. And the problem with selling products in today's society is everybody's carrying one of these around. It's called the most massive computer, and it's getting more and more powerful. And so when you say you have the best policy, customer pulls out their phone, It says who's got the best policy, and there's 10 other people that have a better policy than you. That's not the way to serve somebody. And by the way, is having the best policy always the right solution for our customers? And the answer is no. What we have to do is sit down and ask them, what are you worried about? What matters to you? Are you worried about taxes? Are you worried about inflation? Are you worried about loss of benefits? Isn't one of the big discussions right now about Social Security and what's going to happen to our Medicare? We have more than 100 million people over the age of 50 years old in the United States. Don't ever let anybody tell you that we're going to harm Social Security. We aren't. There's 100 million voters that are going to tell you something different. But you know who is going to be hurt? Our children and our grandchildren. And so you want to know an easy sale? Watch this. You won't even believe it. You go to grandma and grandpa and you say, gosh, you earned these benefits. And wouldn't it be terrible if the government tried to intercede in some way with these benefits that you've earned? But aren't they going to do that at the expense of your children and your grandchildren? So what if we could develop a strategy where you could set up things in such a way so that when you were done using your benefits and you were done using your money, that instead of the government, Wall Street, or the banks, or a nursing home or a hospital getting any of this money, your family would get the money, and it would replace the lost benefits that they weren't going to get because you made sure you got your Social Security and your Medicare. Wouldn't that be amazing? And isn't that the way families stay okay? They work together as families.